Hello, and welcome to the third episode of Just a Tad. I am Michele Levine, and TADs are GFOA's mini classes of 10 minutes or less on an accounting topic. We are going to share some of the insight that we gain when we review almost 4,400 annual comprehensive financial reports each year that are submitted to us in the Certificate of Achievement for Excellence in Financial Reporting. I consider that to be our superpower. And we're going to talk about what we have learned by reviewing ACFRs that are submitted by governments that have implemented GASB 87. And I see some of these as sort of legacies of the pre-GASB 87 accounting rules. So first, we're going to distinguish between lease assets and leased assets, which sometimes people use that term as opposed to lease assets. So we'll distinguish between them. We're going to look at how the lease arrangement should factor into the calculations of net investment in capital assets, a component of net position for both the lessor and the lessee. And we will then look at the accounting for what used to be considered capital leases and how those should be accounted for now. So, leased assets are the non-financial assets that belong to one party, the lessor, but which another party, the lessee, has contracted for the right to use. And of course, that contract is going to be an exchange or exchange-like transaction, and it's going to have a period of time that is specified. Those are the characteristics of leases. They are referred to in the accounting literature as the underlying capital assets, and they are reported by the lessor who still owns them. On the other hand, lease assets, no D, right? This is the lessee's intangible right to use those leased assets. This is reported as a capital asset of the lessee. So, if we have a building that is the subject of the lease, the building itself is the leased or underlying asset. It is reported by the lessor, whereas the right to use that building is the lessee's intangible capital asset. Lessee, right, is going to recognize that intangible capital asset, will include in its disclosures those lease assets, although they must be separated from the assets that are owned by the lessee. So people who are reading should be able to distinguish where the lessee owns the underlying capital asset versus where they have acquired the right to use it. The liability for those future installment payments, right, that's going to be recognized as a capital liability by the lessee. The lessee also, of course, has some lease-specific disclosures that need to be made from the lessee perspective. The lessor is going to have a receivable for those future payments, which is a financial asset. They will have a deferred inflow of resources, which will be amortized as revenue during the life of the contract. They will continue to report those leased or underlying assets, right? Generally, those will be capital assets, and there is no requirement that they be segregated in the lessor's note disclosures from other capital assets, but there are, of course, lessor-specific lease disclosures. With regard to net investment in capital assets, let's start by a quick review, right? Look at the capital assets of the reporting unit, like, for example, governmental activities and business type activities in government-wide financial statements. And of course, now GFOA requires the inclusion of those calculations in an application for our Certificate of Achievement. So starting off with the capital assets, subtracting out capital liabilities where the proceeds were used to acquire, buy, construct, develop, or improve a capital asset that's in that first box, right, in that reporting unit. Also, if we refinance some of those initial liabilities that were used to acquire capital assets, the new liability takes on the capital nature of the old one. Also, when we refinance, we usually have some deferred inflow of resources or deferred outflow of resources, essentially the gain or loss on the refinancing. And that gives us our net investment in capital assets. Now, those leased assets, the underlying assets, are still capital assets of the lessor and will be included. The lessee will include that intangible right to use lease asset, which is a capital asset. On the liability side, well, the lessor may still have some outstanding liability that it used to acquire the underlying capital assets. The lessee is always going to include the lease payable. I'm a fan of the artist formerly known as Prince, the late artist formerly known as Prince. And so I'm going to refer to these as the arrangements formerly known as capital leases, which are now either leases in accordance with GASB 87, which we have been discussing, or they are contracts that transfer ownership. These are lease-like contracts, they may even be called leases, that transfer the ownership of the underlying or leased asset, right, from one party to the other. They do not contain any termination options, so we know the transfer is going to take place. The substance of these transactions they are sales and purchases, not leases. So I'm not going to refer to a lessee, I'm going to refer to a buyer, and I'm not going to refer to a lessor, I'm going to refer to a seller. GAAP tells us in implementation guidance that the buyer should follow the guidance for acquiring capital assets and long-term liabilities, and the seller follows guidance with regard to capital assets and the sale of those assets. What does that mean? Well, it means that the buyer is now going to report the underlying or leased capital assets. So not an intangible right to use, but the actual underlying asset, as well as a capital long-term liability for the installment payments. The seller is no longer going to report the underlying assets. They are going to report a sale. So there should be a gain or a loss in most cases, as well as, of course, the long-term receivable from the buyer. Now, in order to do this, right, the buyer and the seller both need to really know the price of the sale. So from the buyer's perspective, they need to come up with the acquisition value, basically what they would have to pay to buy an equivalent asset on the first day of the contract. They will also, the seller is going to have to know how much gain or loss it has on the sale, and both parties are going to have to distinguish between the interest and principal components of those installment payments, because GASB tells us, right, that we have to use the effective interest method here. So the most obvious thing is if we know or can reasonably estimate the acquisition value, what the buyer would have to pay to buy the same asset outright on the first day of the contract. If that is not known or is not easily estimable, right, we could back into it if we know the interest rate that's going to be charged. Neither is known, we're going to have to figure out which one is easiest or most accurately estimated. Of course, the preference is the acquisition price. But either way, let's assume we have 10 annual payments for a piece of equipment, annual payments of $50,000. Well, if we know that the acquisition price for buying the asset outright is $400,000, then we can back into the interest rate of 5.34% approximately. Otherwise, if we don't have a good way of estimating the acquisition price and we know that the interest rate would be 5.5%, we could instead back into the acquisition price. In this case, that would be about $398,000. How would we do this? Using one of my favorite Excel functions, goal seek. And if this sounds a little bit like the amortization table required for leases, it's pretty similar. So that's it for this TAD. Please watch for future episodes of Just a TAD and email us if you want to suggest a topic for a future TAD. Thank you.